advanced stock option strategy, short call, short naked call. In the previous video, we have learned the first stock option strategy, which is long call. In this video, we are going to learn the second stock option strategy, which is short call, or even it is called naked short call. However, before we go into the strategy, for the people who do not have any understanding on the basics of options, please do visit the series of videos on the introduction of derivatives. The option basics are covered from video 9 to 14. Now let us see how this strategy works. The first thing, when does the investor apply this strategy? The investor is very ambitious and very aggressive. However, his outlook on the market is very bearish. He feels that the stock market or the particular index he wants to take position is going down. Now let us see the risk and reward ratio. The risk for investor by applying this strategy is unlimited. However, the reward is very limited to the amount of premium that he receives. So in spite of having a limited reward and a potential unlimited risk, still the investor feels very confident that he would receive the reward. So that is why this investor is very ambitious and aggressive to apply this strategy. The break-even point is strike price plus premium. Let us further see by an example how this works. So this is a short call strategy. Now here short call strategy means here the investor is selling a call option and in return he is receiving a premium for it. The only profit that the investor makes is the amount of premium. So let us consider that today's Nifty index is around 12,696. So that is the value that it derives, that is 12,696 rupees. Now the investor has sold a call option at 12,600 rupees, for which he received a premium of 156 rupees. So he sold basically an in the money option for which he received a premium of 156 rupees. So the break even, what is the break even here? The break even is nothing but the strike price plus premium, that is 12,600 rupees plus 156 rupees premium. So that equals 12,756 rupees. So if the spot price, the current index, which is currently at 12,696, exceeds 12,756, then the investor is going to make a potentially unlimited loss. Now let us try to understand this by this graph to have a better understanding. The horizontal line, the vertical line, which is the premium paid and received. So here the investor received 156 rupees as the premium. Now the horizontal line, which is the Nifty price, where you can see three different price zones like 12,600, 12,696, 13,000. So it shows the increase and decrease of Nifty price. Now 12,696 is the current spot price where the Nifty currently stands, and 12,600 is the strike price at which the investor has sold this call option and received a 156 rupees premium. Now since the investor sold this call option and currently the Nifty is around 12,696, the buyer of this call option, who is the other party to this option, will not have any right to exercise this option because he would not make profit. Of course he can exercise. 12,600 is the strike price. He has a strike price, but he will not exercise until he makes a good profit. So as long as the spot price is less than 12,600, then the investor here will retain the premium, which is 156 rupees. So that is the only profit and loss that would be made by the investor, which is 156 rupees. However, if the current spot price is exceeding 12,600, that is the point of time the investor who sold this call option will start making loss. Now, once the Nifty keeps on increasing, then the potential loss for this investor is almost unlimited. So if you can see, he will ruin all his profits that he made, that is 156 rupees, and he starts to pay upfront the cash to the buyer. So this is a potentially unlimited loss situation. So this is also called as short naked call. What does it mean? Because this is a derivative product where there is no underlying, so he doesn't really hold Nifty underneath it, he just sold the Nifty, so he has a potential unlimited loss on it. Now this is the point which is at the money, which is a break-even point, at that point there is no profit or no loss situation. Now let us see this more in a tabular form, how the profits are made when the Nifty increases and decreases. Here 12,696 is the current spot price of the Nifty. 12,600 is the strike price of the Nifty. This is the point at which the Nifty was sold by the investor, for which he had received 156 rupees of premium. So if you can see, as long as the Nifty didn't cross certain point like about 12,700, the investor has retained his profit. So at 12,400, still if the Nifty is around 12,400, he still retains a premium of 156 rupees. If it is at 12,500, still he retains a premium of 156 rupees. But once you see, if the Nifty goes to 12,696, his profits are reduced. At 12,700, his profit is only 56 rupees. However, at 12,756, this is the break-even point. We are talking strike price plus premium. At this point, there is neither profit, neither loss. This is more a break-even point. So neither the buyer or the seller is going to make any profit from this transaction. But however, once the Nifty crosses beyond 12,756, that is around 12,800 or 12,900 or 13,000, he is going to make a loss of 44 rupees, minus 144 rupees, minus 244 rupees accordingly. Means in this position, as long as the Nifty goes up, whatever the difference is there with the strike price plus premium, he needs to compensate for it. So this is a potentially unlimited loss that a seller of a call option can have. So this is also called a short naked call. As I was explaining before, since this is a derivative product, the investor doesn't really hold any real Nifty underneath it. So he sells a Nifty, so he has to compensate for the entire loss. In this video, we have gone through the second stock option strategy, short call or naked short call. In the next video, we are going to learn the third stock option strategy, synthetic long call. Please send your feedbacks to demystifying.derivatives@gmail.com. Do subscribe to receive updates from the channel Demystifying Derivatives. Please do like and share the video if you found the content useful. Thank you.